Everybody says, you know what you forgot? You forgot about inflation. You forgot about what can happen if overspend. So I don't want anybody to say that, so I'm doing this. They're going to say it anyway. There's some reporters in this room, they're going to say that this, but look, my conscience is clear. I threw the slide out. Okay. Now, after the government spends, they don't just throw it out the window. They could. Then it would be in cash. But what they normally do is put it in a checking account at the Federal Reserve. It's called a reserve account because it's the Federal Reserve Bank. Okay. I'm doing the second one first. Reserve accounts are checking accounts at the Federal Reserve Bank. They call them reserve accounts at the Federal Reserve Bank to give it a fancy name. Then when people say, well, reserve balances went up, they sound professional, but they're just checking accounts. Okay? The national debt, and there's another kind of account at this central bank, at the Federal Reserve Bank, called Treasury Securities. They're savings accounts. It's already been covered. I'll just leave it at that. You give them money, you get it back with interest. It's called a savings account. Cash is the exact same information as your checking account, but it's written on a piece of paper. So instead of getting your balance on a computer screen or a bank statement, you get to carry it around with you. It is a bank statement. The cash is just a bank statement. It says $100. It's the same thing. It's the thing you can use to make payments to the government with taxes, for taxes. Once the government has spent, that money appears in one of those three forms. Okay? So if the government spends without taxing, just spends, that's called deficit spending. Say on day one the government just spends $100. It's going to be one of three places. It's going to be cash in circulation, or in a checking account, or in your savings account, somebody's savings account. There's no other choice. The dollar has no other existence other than those three places. And all of this equals the world's net savings of dollar financial assets. There are $13 trillion or so in the savings accounts and checking accounts and cash, equal to the penny, to the cumulative deficit spending. That's how much the government has spent and stuck into those accounts, but hasn't yet taxed and taken out of those accounts. Spending puts the money into the accounts, taxing takes it out. If you put it in and don't take it out, it's a deficit. It's our savings. It's held by you, me, China, whoever owns Treasury Securities. Little diagram to explain it here. See how it works. Just to make it a graphic that I did a long time ago. Appears in Randy's book, Understanding Modern Money. Up at the top, you have, I'll do it from here so I have the microphone, I guess. In the middle, non-government sectors, that's all of us. That's everybody except the government. Okay? Well, let's start at the bottom. The government imposes a tax. We have to pay this tax or we can't get out of the room. We're going to lose our house and our car. When I say tax, just think of a property tax, because that's easy. If you start thinking of an income tax and what if you work, what if you don't work, it works, but you'll lose track of the rest of what I'm saying. But just trust me, it does work. But think of it as a head tax or a property tax, just to keep it simple. So the government levies a tax, and now we need the money to pay the tax. Okay, notice I have taxes going out down into the drain. I don't circulate them back. There is no such thing. Okay. We ship real goods and services to the government. The government's doing this because it wants to provision itself. And the government gives us the money we need to pay the tax. Goods and services to government, money to pay the tax. Some gets paid in taxes, some gets saved. And where does it go? It goes to the tin shed in Canberra, the warehouse over on the right. In Australia, it's this tin shed over here. We've got a big concrete building. And that's how it's held. It's held in one of those three forms: cash, reserves, or Treasury securities. All that Fed operations do is shuffle around the difference between cash, reserves, and Treasury securities. When the Fed buys securities from the private sector, their securities go down and their cash, the reserves go up. When the public wants more cash, the reserves go down and the cash goes up. The total is always the same. It's always equal to the deficit. The only place that net financial assets can come from is government deficit spending. This is all accounting. No theory, no philosophy. Ask anybody at the CBO and they say, yeah, it has to add up to the penny, or we have to stay late and find our arithmetic mistake. So last year, the government spent $1.5 trillion more than it taxed. That money went into the warehouse. It's now held as Treasury securities, reserves, or cash, otherwise known as savings. And sure enough, last year, savings went up by exactly that amount to the penny. when you include all the non-government sectors. Deficit spending adds to our savings. I think I just said that. Now, we're going to walk through an example that's going to take intense concentration here, so you ready? Okay. We're going to assume you're the only person in the economy. We're going to personalize this. And you happen to have $100 in your checking account. And the government wants to deficit spend $100 to hire you as a consultant. Washington hires a lot of consultants. I figure this is good a thing as any of what deficit spending is, what money's spent on. First thing they do is they offer for sale. We can start in anywhere, but I'm going to start with them offering a Treasury Security. They offer you $100 worth of Treasury Securities, and you'd say, okay, I'll buy it. Because you buy it at auction, you get to choose your interest rate, and the highest bidder gets it, or the lowest bidder gets it, lowest yield, highest price. And so you say, yeah, I like that yield on that Treasury Security, I'm going to buy it. So now you just took your $100 out of your checking account, it goes into your savings account called a Treasury Security. Have you lost anything? Has the government taken away your money? No. I've never heard anybody say, I wish the government would pay off these Treasury Securities so I get my money back. I don't think anybody else has either. They are money. In fact, it's better than money, or you wouldn't have bought it. It's voluntary. Okay, so now you still have your $100. It's just in a savings account instead of a checking account. Now the government, quote, has the money in their mindset to pay you your consulting fee. So you go in and you give them some advice, and they pay you $100. And they put it in your checking account. Okay, you now have the new Treasury Security, and you got the $100 back in your checking account, and nothing is crowded out. It has nothing to do with loans, deposits, banking, anything. It's just a self-contained thing. It has no effect on any other part of the private sector. And if you remember my previous example, the government spent more than a tax. You held it in a warehouse, and you held it in the form of a savings account. You had a checking account, now you have a checking account and a savings account. Government deficits add to savings to the penny. The deficit clock can be renamed the savings clock. This has already been covered. Same thing. Fiscal Sustainability Review. Spending is not constrained by revenues. Spending is changing numbers up, putting numbers into our checking accounts. Taxing is changing numbers down, taking numbers out of our checking account. Borrowing is moving numbers from our checking account to our savings account. There is no numerical limit to any of this. Paying interest is changing the number up in our savings account. Government can always make any payment of dollars it wants to make. Okay, this is all we're talking about. It's a nominal system. We're talking about there are no nominal constraints. The risk is inflation and not insolvency or not solvency. There's no solvency risk.